Hello, my name is Kathy, and I'm speaking to you on behalf of the Arkansas Small Business and Technology Development Center, or ASBTDC. Today, we're going to talk about financial basics for small businesses. Think about why you decided to own your own business. Was it to follow a dream or to be your own boss? To achieve your goals, the company must generate enough money to pay bills, cover debt payments, and hopefully make a profit. These things don't happen by accident. You must carefully monitor business finances and make sound financial decisions. Today, we will talk about 5 critical aspects of establishing and maintaining the financial health of your business. These include the importance of record keeping, types of financial statements, creating a financial forecast, using your budget, and financial benchmarking. Now let's work through each of these 5 points so you can be better prepared to manage your business finances. Record keeping is one of the most important functions in your business. The first step is to have a system in place where you record all transactions. The system should provide financial statements regularly. Accurate records enable you to make informed financial decisions about your business. It is a measure of your progress. Reviewing finances once a year at tax time is not enough. You should review your financial statements every month at a minimum. Several financial software applications and online platforms are available to businesses. Talk with your accountant and find out what they would recommend for your situation. Whichever path you choose, recognize accuracy and consistency are paramount. Most small business owners do not get into business to keep up with financial records, so it may not be your strength. If you need help, you can pay a bookkeeper or accountant. Above all, avoid unreported cash sales. If a business operates in an industry where cash transactions are common, it can be tempting to let the cash go unreported to reduce tax liability. Underreporting sales is illegal and will reduce your business's value when selling. There are 3 types of financial statements that are important to business owners. Each provides a different perspective on your business finances. They are income statement, balance sheet, and cash flow statement. Today, we will briefly explain the 3 types of financial statements and discuss what information each statement provides to a business owner. The income statement. The income statement is also known as the profit and loss, or P&L. It shows your sales and expenses over a period of time, such as a month, quarter, or year, and whether or not the business is profitable. The balance sheet. The balance sheet is a picture at a point in time of a business's assets, liabilities, and equity. Assets are the things you own, such as cash, equipment, and inventory. Liabilities include things you owe, like loans, credit card debt, and accounts payable. Equity is the value of the assets less any liability attached to those assets. The formula for the balance sheet to balance is assets equals liabilities plus equity. The difference between assets and liability is net worth. A higher net worth is good. Low or negative net worth is generally bad. The cash flow statement. As we all know, cash is king, so the cash flow projection is a valuable decision-making tool. The cash flow statement shows where cash comes from, including sales and any borrowing activity, as well as investment monies. The cash flow statement also shows when cash goes out, including expenses and loan payments. Part of managing finances includes creating a forecast or budgeting. A monthly budget is critical so that you can feel confident the business will earn enough to pay the bills and the owner. To develop a financial forecast that is reasonable, due diligence is required. Sales and expense projections should be based on researching the market and industry and not just guessing. The reliability of your financial projections is based on the quality of research and assumptions used to develop your numbers. When creating your projections, it is important to be conservative. Overprojecting sales is a common problem. Underestimating expenses is also easy to do. In either situation, the forecast may show a profit, while the actual results can be very different, which leads to big problems. Once you have created a financial projection, what can you do with it? First and foremost, financial projections can assist in determining whether or not a business or project seems financially feasible in its current form. For startup businesses, the projections can show whether or not the business is expected to make or lose money. If it does not show a positive cash flow, the prospective owner has to decide whether to make changes to the business or not pursue the project at all. For existing businesses, the projections can help the owner decide whether or not certain business decisions would be profitable. For example, should the business add a new product line, hire new employees, or open a new location? If you decide to move forward with the project, these financial projections become an integral part of the business plan. If you plan to pursue financing or investors, the projections are critical to demonstrating the financial performance of the business and the ability to repay any loan or investment. The loan officer at your financial institution will lean heavily on these forecasts and will verify the assumptions you have made to create the projections. The projected financial statements can also be used as a basis for comparing month-to-month actual sales and expenses. Financial projections can help the owner spot potential problems before they occur. For example, seasonal businesses may experience inconsistent cash flow throughout the year. Understanding cash flow can help the owner determine how much working capital is needed to sustain the business during the off-season. Once you have developed financial projections, you can compare your historical performance and forecast against financial information from the industry. This is called financial benchmarking. These financial benchmarks can assist the loan officer or investor in determining the performance of the business related to similar businesses in the industry. Financial benchmarking as part of your ongoing business analysis will help you stay up to date with any market trends or industry trends. It will also help to identify any weaknesses your business needs to improve. Work with your local ASBTDC consultant to gather industry data so we can help you compare your financials to the industry standard annually. Benchmarking will allow you to manage resources, such as people, inventory, and supplies, to become as efficient as possible in your business and maximize profitability. As we conclude our discussion, remember the importance of establishing and maintaining an accurate record-keeping system. Work with your accountant to ensure your system is set up correctly and that data is entered properly. Financial statements reflect the day-to-day activities and decisions in your business. Review these monthly and understand what each statement means to the business. The financial health of the company is critical for business longevity and growth. Talk with your accountant or ASBTDC about an annual financial checkup or if you need help understanding financial statements. This will help you make informed decisions about your company, whether in times of challenges or in times of growth and expansion.